Welcome back. Well, in a few minutes, we'll get the opening rates. But today, the big event post-market actually is going to be TCS's numbers. Rima, run us through the key expectations on this one.
Well, good numbers on the growth front. Dollar revenue growth of 1.7% on a quarter-on-quarter basis. Constant currency revenue growth seen in a range of 3.5% to 4%. So these are robust top-line growth numbers. Now you would wonder, why is the constant currency revenue growth so high at close to 4%, but the dollar revenue growth is subdued at just 1.7% in terms of expectations? Well, TCS gets close to 45% of its revenues outside of the USD, which means from the Eurozone, from the pound, as well as the Australian dollar. So when TCS converts the euro revenues back into the dollar at a time when these currencies have depreciated against the dollar, the company loses out, which is why constant currency revenue growth is seen higher, but the dollar revenue growth is seen at 1.7%. Margins are seen down 120 basis points quarter on quarter, below 24%, impacted by the wage hikes which kick in this quarter, and profits, according to our poll, should be down 1.2% at 9,800 crore. But this time, the focus is going to go beyond numbers. It's going to be on the demand environment for FY24. There are concerns about a recessionary environment globally. There are fears of tech budgets being squeezed. So what the management has to say about demand holding out beyond FY23 is going to be very crucial. At least in the last commentary, the management was very optimistic about the demand being robust. They had said the tech budgets will be the last to get hit. Also, watch out for if this uncertain macro environment starts slowing down on deal conversions or deal wins. So that's going to be a crucial parameter to track. Hiring, attrition continue to be on top of investors' minds. In terms of valuations, well, the stock has corrected. It used to trade at a peak valuation multiple of 32 times. It's come down to 25 times. So there has been a valuation reset on the way down for TCS, like we've seen with the rest of the pack. Year to date, the stock is down. It's corrected significantly from its 52-week high as well. But its performance relative to the other large cap companies has been a lot better.
Okay, all right, Rima, we're going to brace ourselves for those set of numbers. Rima's going to be busy this evening. But let's get in Sandip Agarwal as well, research analyst, institutional equities at Edelweiss Securities, who in fact, got that call right earlier in the cycle when the ID stocks rallied. They've come off from the top. So Sandeep, morning. Thanks so much for joining in. Well, could you give us a sense in terms of the margin outlook? Now, the management has already said that it's going to be fairly volatile. Our poll is factoring in a downtick of around 130 basis points. At what level would it be termed as a disappointment, since the street is as it is bracing for a margin contraction?
I think this quarter, you will see at least 150 basis point margin contraction and maybe slightly more, because we have to keep in mind two things. One, there is a wage hike impact, and second, there is a visa cost which comes in. And also, there is a revenge travel which is happening, because all the RMs who are there in the company, they all want to meet their clients. It is long, right? 2 years, and they want to go and meet. They want to warm up their relationship again. They want to meet in person, and everyone wants to meet. Even the client wants to meet. So this 1 quarter, 2 quarters, you will see a very strong comeback of travel cost. But then again, it will start going down, because there is a systematic change, and we have spoken to several clients, and they have all said that we don't need, like earlier days, that 15-20 people travel for one deal over a period of 3 to 6 months. We want only one person traveling, and rest of them can connect through the Teams or the Zoom, other options which are available. And it also allows us to bring in more people from across globe to when the deal is discussed. So I think you will see a revenge kind of spend in travel this quarter, and maybe some bit next quarter, and then it will cool off. And this quarter there is a wage hike and there is a visa. So this is a quarter where margins will obviously have a bigger hit. I don't think it will be 130 pips. It will be more than 150 pips. And if it is 130 pips, I would be very happy, because it will mean that they have been able to absorb lot of pressure on the margins through operational efficiency and maybe pricing gains.
Okay, Sandeep, good morning. You have of course been the biggest unadulterated bull on the IT space, but in our last interaction about 3 or 4 months back, you had said that it was becoming tough for you also to justify some of the valuations. But after this correction now, have they come back to reasonable sort of zone, especially for the large cap IT?
Yes, so Anuj, I would say this, that valuations have corrected substantially, and because of the kind of hikes which we have seen in the interest rates and the kind of hikes which we are expecting, what happens is our implied multiple on the DCF goes down by 20%. So the multiples which we are also assigning forward looking, we are looking because of the interest rate hike are demanding more growth to justify that. And And in an environment where we don't know what will be the reality, although I have a very different perspective on tech spends, I think, current multiples now are very reasonable. Only thing which I would like to highlight is that, in IT, what happens is people are always concerned about the future. Like Rima said, that everyone would be wanting to know more on FY24. No one wants to know anything about FY23. And if management doesn't give any guidance on FY24 qualitatively, or they don't speak about how the demand will be, then even if you are posting good numbers on margins or growth, maybe stock doesn't show any movement. But I would say this thing that IT stocks are very good wealth creator. The dividend yields are very good. If you see last 10 years return, they are between 25 to 40 times from the large caps, forget the mid caps. So if someone wants to accumulate and start building a portfolio, it is the best time to build. You may see a 5-7% downside in the large cap from here also on a bad day. But then in next 1 year, you will definitely make a lot of money in the sector. This is a cash generating and annuity business.
Valuations are reasonable, and this is perhaps the best time to start accumulating and building your IT portfolio. Sandip, that point is taken. What will positively surprise the street this time from TCS, and what will negatively surprise the street? Could you lay out some markers?
So I think, positive surprise will be if attrition cools off substantially and the hiring numbers remain robust. And TCVs are good. So that is one. And secondly, the qualitative commentary, what TCS can say. These will positively surprise. I honestly don't think that, a growth of 50 basis point higher or a margin of 30-40 basis point higher than estimate will make a big move in the stock. The big thing will be if the management can continue to speak on the demand tech cycle, which they have said last several quarters that it is a long-term tech up cycle. And if they can reiterate that thesis, even if there is a short-term lack of visibility, but longer-term remains intact, then I think that will be the thing to move the stock. That is the way I see it.
All right. Sandip, you want to quantify attrition number cooling off by how many basis points would impress you?
So I will say you again, in this quarter, there are two things combination. One, seasonally, this quarter is a quarter of a lower attrition because people take their wage, performance benefits, incentives and everything. So they wait for that. So I think, if a cool off of 200-300 basis point is there in a TCS, which is already at 17.4 or a lower base, it will be very positive. I will give you a basic math. 1% fall in attrition will lead to 35 basis point improvement in margin over a period of over next 12 months. So everyone's attrition is eating more cost today in the P&L rather than the wage hike or any other cost. Because attrition forces you also to get into subcontractors and everything. So we have done a very detailed math a couple of years back on how attrition hits this industry. Every 1% increase in attrition is like 35-40 basis point margin dilution. So you see TCS has gone up from 10.5-11% to now 17.5. So almost 250 basis point of lever is there if the attrition comes down. But I don't want attrition to come down that sharply also, because it also indicates that demand is receding. So I would be more comfortable in a 14% kind of attrition number.
Sandeep, what exactly is going on with Wipro and Tech Mahindra? I mean, they just fallen so much, literally half of what they were 5 or 6 months back.
So in Tech Mahindra, see, Anuj, whenever we have discussed earlier also, I have told very clearly that, in 5G, people are very optimistic. All the global conferences, everyone speaks only about 5G. But if you see actual deal awards or deals which are given, that is minuscule because world was in lockdown. You can't prove the use case of 5G. 5G will be used in gaming industry, in the delivery industry, but nothing has happened on the use case justification or on the demo of those use cases because of the lockdown. So that is the reason, despite all the positive talks, it has not converged into numbers, and it will still take 6 to 9 months. So I think that is the reason Tech Mahindra is behaving the way. Secondly, they have not been able to manage the margins as well others have been. And in case of Wipro, the challenge is in global, not only in India, globally. Wherever there is a large acquisition, it has always been very difficult to integrate. So what Wipro has done is a big acquisition, and people are worried that that acquisition will lead to a lot of attrition within both the entities, acquired and acquiring entity. And second, it will lead to margin dilution the way it happened in case of Tech Mahindra when they acquired LCC. So that is the concern. But I would say that at this price, all the stocks in large cap are looking extremely attractive. As I said, I don't see more than 5-7% downside with a huge upside if someone is willing to take a call beyond 6 months when clarity on FY24 will emerge.
Sandeep, just one point. I want to get back to the point that you spoke about what will positively surprise the street. One of them, of course, is attrition number. And two, you spoke about qualitative commentary. Well, the qualitative commentary from the IT management in the last 3 months has been very strong. They've consistently said that demand is robust, their order books are strong, and they don't see any hit to demand despite the macro situation worsening. But yet the stocks have corrected. TCS did fall from levels of 4,000 to 3,000. So do you think a reiteration of a positive demand environment is enough to allay the street's concerns?
I think so, because see what has happened while management has been saying that, but you have counter data also coming in. For example, if you see how US retailers are commenting, they are saying that, the revenues will see a dip, their profits will see a dip, and they contribute 20% to the Indian IT industry. So, and similarly, within the TMT segment, the FANGs companies, particularly like the Netflix and Facebook, they have all cut guidance. So I think, that has also played on the minds of the investor. And also, I think it is also a factor of the FII selling. If you see, FIIs are consistently selling, and it doesn't necessarily, they are even selling other sectors very aggressively. So, that is also the reason the stocks have corrected. I would not simply say that, it is because of only fear of recession or only fear of global macros that the stocks have corrected, because it implies to other sectors also indirectly, directly. But I would only simply say that we are in a very sweet spot in my view. If someone is taking more than 6 months view, because our pricing hike has already happened in the industry. Wage hikes will be normal because now the attrition have cooled off because of startup ecosystem cooling off substantially, and currency is also not against the tech industry. So all three things will add on to better margins and better growth going forward. It is a matter of time the stocks will see a strong recovery.
Sandeep, thanks a lot for joining us. Always good talking to you and getting sense of what's happening. Yes, I mean, of course, there's that global factor, the interest rate hike, all of that, FI selling, all of that impacts. It's not just, what the companies themselves are doing. The pre-open has settled 140 point higher on the Nifty and 338 point higher